It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. My name is Mike Bernard, your host. I am also one of the certified financial planners on the show. Thanks for being with us. With me in the KFG studios, a bearded or more gruff Kevin Korhorn for the season. And between us, Josh Gregory.
Yeah, it's good to be here, Mike. My wife says I've got a hedgehog on my face. So
I think it looks good.
Thank you. Well, hey, one of the most common questions that a financial advisor gets asked, especially towards the end of the year, is how much can I give without it being taxable? And on today's show, we're going to answer that question as well as discuss some new gifting strategies to consider that the tax laws are all brand new as of January of 2018.
Yeah. I think this is one of the most common questions that financial advisors get asked. It's about gifting and taxes and all of that. So we're going to be hitting that today. A great question from Eileen is teeing that up. We've got some other questions we're going to hit as well. If you have a question or have any needs, reach out to us. We'd love to help you. You can find us online, wisemoneyradio.com. You can call or text us, 574-222-2000. Yep, call or text, 574-222-2000. Social media as well. We've got every episode on the YouTube channel. You can check us out right there. Facebook, Twitter, like it, subscribe, all that sort of stuff. Just search Wise Money Radio. All right, as Kevin prefaced, we're kicking today's program off with a great question from Eileen. She's 67 from Buchanan. Here's what she asked. For Christmas this year, we'd like to give each of our two kids a sizable gift from an inheritance that we received this year. We're thinking $25,000 each. Very generous. Mm-hmm. Will that be taxable to them or to me?
Yeah, I like how you preface this by saying that this is a question that we hear on a regular basis, especially this time of year, because it's maybe more common than you think that someone might receive an inheritance or they have some dollars and they want to bless their family around the Christmas holidays. And when you start getting into some of these larger dollar amounts, the concern is, well, is this going to hurt them in some way?
Yeah, I'm intending to help. Is this going to harm?
Exactly. And I think most people's minds go to, is this going to be treated as income to them in some way? And the good news is, if you were to actually scrutinize the tax return and look at the front page of your return, what you won't find there is a line that says gifts received. That is not income to the recipient. But we still talk about periodically this idea of gift taxes, which is a totally different animal. But when you write a check and you give it to a family member, you're giving them cash essentially. That is not income to them. So let's at least just put Eileen's mind at rest here. Go ahead and gift that cash if you want to. It's not going to be income to them. Doesn't mean it's not the only issue that we need to think about, though.
Right. If you're giving a gift and you're writing the check out of your checkbook, likely the taxes have already been paid on that. Mm-hmm. But there can be situations where if you give it to your children, it could be taxable. Yep. So if you're gifting $25,000 of stock to your children, you're also gifting them your basis. So if it was $50,000 of stock that you were cutting in half and your basis was $10,000, each of the children would have $5,000 of basis in the $25,000 that they receive.
Okay, so let me interject here because there's some
jargon
going on there. Mm-hmm. Basis that Kevin's referring to is a tax term that a CPA would use to define the money that's already been taxed. So if you bought some stock years and years ago and it has grown in value, your cost basis is the portion of that investment that you've already paid tax on. And the growth or the gains, kind of the profit, if you will, that has accumulated over the years, that has not been taxed. And if you sell it during your ownership or during your lifetime, you will pay tax on that, potentially. It at least has to be counted as income to you. It's a
right.
Capital gain is the term that the CPA would use. If you gift that stock and it's your kids who sell it, then they are the ones who end up counting that capital gain as income to them. Mm-hmm. So that's why Kevin's drawing a distinction here between writing a check, giving cash, which has none of that capital gain built into it. There is no taxable hit that comes with cash or writing a check to them. but an investment that you gift to them, that could have tax implications for them.
Although that's clear to me, hopefully it's clear to you as well. We got complicated pretty quick. Let's take it back to a little more basic level. You're writing a check and gifting money to a family member or another individual.
Yeah.
The IRS has something. Josh, you said it perfect. It's not income tax, but is there gift tax on that? Well, the IRS has an annual gift exclusion amount, which is $15,000 per person. So we don't even need to talk about taxes. You don't even need to tell the IRS if it's below $15,000. And there's this very interesting thing that the IRS put in that section of the code about gift splitting. So Eileen, you reference us, I think, a couple times in your question. So I presume you're married. So technically, you and your husband can each give $15,000 to one of the kids. So that's 30. And if one of the kids is married, you and your husband can each give 15 to each of them. So that's now 60,000 that you can give. And not only is it not taxed, you don't even need to tell the IRS about it.
Not even a reportable
Yeah, and
event.
in the spirit of the jargon-free zone, though, gift splitting, that makes sense to us because this is our life.
Mm-hmm.
But gift splitting might not make sense to someone who's hearing it for the first time. So Joshua is probably the best guy ever to explain gift splitting.
Okay, I appreciate that. So to me, gift splitting is really just each of the two spouses taking advantage of that $15,000 a year coupon that Mike was referring to. Each of you are allowed to give $15,000. Mike described it well. Don't just think that you, Eileen, can give $15,000 and then that's the end. You wanted to give them $25,000. Well, you can use your $15,000 freebie with the IRS, and your husband could as well.
Mm-hmm.
If you are not married, Eileen, but your child is, as Mike said, you could give $15,000 technically to your son and daughter-in-law then.
That's right. That's right. So you can create it counts as a bigger amount that you can give to someone without needing to tell the IRS.
And sometimes if you don't understand how all this works, it can be confusing because, Eileen, this $50,000 might have come from an inheritance from your parents. And so you say, well, can I really do gift splitting? If I'm married, can I do gift splitting because this is really my money? Look, the money in your checking account, the IRS doesn't care whose money that is. So you can use your coupon. So you have $15,000. Your husband has a $15,000 coupon. So technically, you could give $30,000 to each of your children without any issues, no matter whose money it is.
You know, there may be someone listening out there who wants to gift even larger dollar amounts. Maybe there's just a massive blessing that you want to pour on a loved one, and it goes above and beyond $15,000. And even if you got creative and you and your spouse were both gifting, it's still too big. The assurance, I guess, that I would give you is that there's an even bigger coupon that all of us get to use during our entire lifetime. It's over $11 million.
That's crazy.
Okay.
Yeah.
Here in 2018, it's $11,180,000. You're allowed to gift that amount of money, spread it out throughout your lifetime or at death, and still pay no gift tax. But you have to report on that gift if you're creeping over that 15,000 number that Mike was referring to earlier.
Yep. You have to tell the IRS. You have to file a gift tax return. There's no tax due. So when people ask me that, I tell them, yeah, there's no tax involved. You'll have to file the return, and that costs money, and there's a little time involved with that, but it shouldn't really be much. But there's no tax.
That's right. It's more of an administrative just reporting so that you can keep tabs and the IRS keeps tabs on how much of that $11 million amount you've used up. Mm-hmm. Most of us don't have a problem exceeding that $11 million mark, right?
And remember, Mom and Dad, charity starts at home. So one thing that I would like to get into, and I don't think we're going to have time in this segment, though, I would like to get into the question for Eileen, are you gifting or are you waging? So
okay.
Can we hit that in the next segment?
Yeah. So we also need to talk about, a lot of times when you're motivated to give, you're thinking intentions. And Kevin, I think that might be what you're alluding to. And one other area that we're going to be touching on then is, well, what if you gift to a son or daughter for the education of your grandchild or something like that? And how does that work? Because actually the rules are a little different when you're using a 529, and plus you want to take advantage of some tax benefits as well. So we're going to get into that. And then lastly, talk about all this giving person to person. This is the time of year when you're giving to charities as well. And with the tax law changes, it's going to be important that you know, well, are you doing it the right way to get as much benefit as you can? We're going to hit all of that and more coming up here on Wise Money with Korhorn Financial Group. All right.
Yeah, I think it's really important, just because of what we deal with every day, for Eileen to examine her heart and say, hey, why are you doing this? Are you doing this because a gift is a gift is a gift, and here you go, Mike and Josh, do with it what you will. Mm-hmm. A wage is, here you go, Mike and Josh, and I'm going to watch how you use this, and you better fill in the blank. That's a wage. That's in essence, you're working for me. Mm-hmm. So because it's supposed to be a blessing, right?
Yeah.
Is it? Because that's the question. Is this supposed to be a blessing, or is this supposed to be part of my joystick that I use to move around to control you? And we can't know, right? All we can do is examine methods. Method: I gave my son $25,000. What was my motive? My motive was to make sure he got married, or he didn't marry that girl. my motive was, he's got gambling debts, and I want him to pay off those gambling debts. And what? Because that's a big question. Because the money can be a blessing or it can wreck someone.
I think it's.
So I don't know I don't know how much, if we have enough time to get into that a little bit, but
sounds like we're going to.
I think
teed it out there.
I think we need to.
Sure. I don't know if I dwell on it because
let's move quickly.
I think it might be common that parents say, I want to help pay off some of the student loans. I don't know how common it is. Someone says, I'll give you $10,000 if you don't get married to your fiance. I don't know. I mean, that might happen, but I don't think
it happened to me.
And then you met Lori. Just kidding. So.
No, I know, but
you're
because I would say, hey, if you do want to control the money, and I don't have any problem with that. This would be a great time to talk to your kids about their finances. If the kids aren't funding Roth IRAs or 529s or these types of things, help them do it.
Right.
Get them going.
Right. Yeah. All right.
Okay.
So,
is the logo facing the camera?
Sure.
It's very important.
Do you want to start with that,
Sure.
or start with the 529 stuff?
Let's start with that and go into the 529.
Okay. How do the new tax laws impact your gifting strategies this time of year? You got to be intentional about it. You have to be aware of what to do. We're going to be talking about that in just a second, share with you the new gifting strategies so that you can make your year-end giving with all the lights on. We're so glad that you're with us. This is Wise Money with Korhorn Financial Group. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Gosh, I've missed all of us being together. It's been a while since the three of us have been here. So thank you to the attorneys at Ledoux, Kern & Keene, as well as First State Bank for making the Wise Money Show possible. Appreciate that very much. If you have any questions, we're right in the middle of one from Eileen. If you have a question, reach out to us, wisemoneyradio.com. You can submit questions right there on the right. They turn into emails and come right to me. Or you can call or text 574-222-2000. That's 574-222-2000. And lastly, on social media, you can follow, you can like, you can submit questions that way as well. Facebook, Twitter, YouTube. Just search Wise Money Radio. All right, let me just hit that again. We're sort of wrapping up. Eileen's question, she's 67, from Buchanan. For Christmas this year, she wanted to give each of the two kids a sizable gift from an inheritance that she received, $25,000 to each of the kids. Will it be taxable? We just addressed the annual gift tax exclusion and some other kind of fancy things there, but the short answer, Eileen, is no. But there are a couple layers below that we need to hit. Kevin, you were talking about the motivation for giving.
Yeah, and I think it's important to consider, but just a quick true story. When I was in college, I had a dog named Vicky, and she had 3 legs because she'd gotten shot during hunting season, and so she had 3 legs. And I adopted a cat. It was a stray cat, and I brought it in and took care of it. And it had 3 legs, and I named it Eileen.
Oh, geez.
And
Is that a true story?
That is a true story. That is a true story. So I was the guy with the 3-legged cat and the 3-legged dog. And Eileen's one of my top 10 favorite woman names. So
There you go.
anyway, excuse that aside. My brain. But the question is, as you're giving money, and we deal with internal finance, and we see when things are done absolutely just very well and things aren't, and there can be some unintended consequences. So Eileen, one of the things that I would encourage you to consider, and if you are married, to talk to your husband about this, is why are we doing this? Why are we giving the money to our children? I'm going to assume your motives are pure. Our job is never to make value judgments, if we're working with you as a client, our job is never to tell you what to do. But our job is to talk to you through the internal finance and the potential unintended consequences. So I like to talk to folks and think along the lines of, hey, this money is meant to be a blessing. We at least know that. So the question is this money going to bless the children? Is it going to accelerate their progress? Or is it going to create an obstacle for them? Is it going to create a distraction in their life?
And normally, if you've already thought, hey, I'm going to make this gift, you'd never think the second. You would just always think, no, this is really going to be a benefit to them. But Kevin, what you're talking about then is, no, pause for just a second and say, what are some potential unintended consequences here?
And that's difficult to do sometimes because you don't know, you know the spirit that you are giving the gift. You don't know how it's going to be received, though. And I've had clients where I work with more than one generation within a family, and I have spoken with the giver and I've spoken with the receiver, and there's a mismatch in how, the spirit behind the reception or the transaction that's given. Where, one parent, for example, is thinking, well, this is just sort of an advance on their inheritance. They know that they're getting some of their money ahead of, what they would be receiving when I pass away. And the recipient, I've observed before an unintended consequence of them maybe becoming a little bit reckless because they just know they can keep going back to that well anytime they want. And what's the difference between me receiving it now versus me receiving it down the road? The difference could be in the habits that recipient forms or doesn't form.
Right.
Because you're actually protecting them from consequences in their life, or you're maybe making resources available that they didn't have to work hard to earn, and that can change someone over time.
Yeah, unearned money is kind of the hardest money to handle by far, and it takes skill and character to be able to handle money. You can have both of those at 18, and you can lack both of those at 68. So it's not necessarily an age-based thing. So when I'm coaching up clients in the gifting area, I tell them, to oversimplify, I just say, hey, is this a gift or is it a wage? A gift is no strings attached. Here, this is your money. Do whatever you want with it. You can walk down the street and give it to a homeless person. I don't care. You can take the kids to Disneyland. You can, whatever you want to do, you go do it. A wage is, hey, I'm giving you this money, but there's something expected in exchange. And I personally don't have any problem with the second one, especially if your children could use some help or some guidance. If your children financially have it all going on and they're working with a certified financial planner, I'm going to trust that they've prioritized their financial life and they know exactly where they would put the next $25,000. But if they're not working with a financial planner or they've got some financial issues, you might, as a parent, want to attach some strings to this and say, hey, these are the things that I would hope that you would do with it.
Right. So the point is to be clear, communicate, understand your own intentions, but then communicate with the recipient and so on. So this, I know this is tricky. It's behavioral finance, it's internal, but we've seen challenges with this, which is why we want to make you aware of it. There was something else related to giving, Kevin, that you brought up, the circumstance you had with a client recently about a similar size of gift, but regarding to a 529 plan. Can you hit that real quick? Because giving, when you're putting money in a 529 plan, you've got to consider a couple different things with that.
Yeah, if you live in Indiana or if you have income in Indiana and you pay tax on that income in Indiana, there's something very unique about the Indiana 529 plan, and that is that I can put $5,000 into the 529 plan and think $5,000 per tax return.
Yeah.
So if I'm an individual or I'm a couple, I can put $5,000 in. I get a 20% credit on that up to $1,000. So a lot of people in Indiana think, well, the most I can put into a 529 plan is $5,000. Nope, you can put a whole lot more in that, but that's all that you can put in and get your $1,000 credit per year.
Correct.
So I was working with a client who had an event and had let's say $50,000 and said, hey, I want to split this money between my girls. I want 25 to go to each of their accounts. So I said, okay, and they said, this is for education. The purpose, I want this money to fund their education. So I just want to put it in their 529 plan and be done. And I'll check the box, and I have peace of mind knowing that it's done. And I love their heart, and I love their spirit and their excitement about getting some goals achieved. But what I had to explain to them was, if you take that and do it all in 1 year, you're going to get your $1,000 credit that year.
Yeah, you'll get $1,000 credit on that $25,000 that you put in.
Right, each. Mm-hmm. If you tip it on its side and you put $5,000 in over the next 10 years, you'll get $10,000 of credit.
Yeah, $1,000 a year on that same amount of money.
Right. So the question is, would I rather have 1,000 or would I rather have 10,000? And it was difficult because of their exuberance to get the job done. And what I encourage them to do is put $2,500 into each of the 529s, and then set up a joint account for husband and wife and put the $45,000 in that. Let that grow, and every year we'll peel $5,000 out of that account into the 529.
You know, where my mind goes when I hear advice like that is it's marrying together the investment objective of growing an account for for college in this case with the tax planning.
Yeah.
And the two strategies have to inform each other. They have to be integrated together. Otherwise, as you point out, that could have been $9,000 worth of tax credits left on the table, never claimed for your family's benefit.
That's why we love financial planning. Right?
Yep,
We talk about it every
absolutely.
show. That is why we love financial planning. You're not going to get that. You're not going to see it if you're not doing comprehensive financial planning. All right, we've got to talk about the new gifting strategies that you need to consider because of the new tax laws. We're hitting that next on Wise Money with Korhorn Financial Group. Good stuff. Yeah, that was good.
Jake was saying how much he loved being on the Millennial Show.
Oh, yeah?
And I said, dude, we should, at the end of every week, we should just do a 10-minute podcast just talking about what we learned, because I saw so many clients this week, and there's so much.
Yeah.
There's so much good stuff that I learn every week.
Mm-hmm. Yep.
So are we still going to hit Tammy's question?
I don't know. What day is it? I don't know. I think so. If we have time. So we're launching the third segment. On our outline, we're in segment 2. I think segment 2 could take the rest of the show. It's possible. Open it. See that, YouTube?
Careful, Mike.
I opened it earlier. I was trying to not fall. Standing on a chair, a swivel chair. I didn't fall.
Attaboy.
You're a ninja.
Pulled the hammy.
Uh-oh, there's another surgery.
Yeah. All right. I should. YouTubers, I'll share it on the show as well, but our blog for December is about gifting strategies as well. So if you're a fan of the Wise Money Show, it's possible you'll be a fan of the Wise Money blog. And we have the site wisemoneyblog.com, and that directs immediately.
Wise Money Radio.
No, I think we're supposed to be working on that.
Should be easy to find. I was talking about the blog this morning, and my daughter said, "You guys have a blog?" I'm thinking, I cannot believe she's not read every one of our blogs.
Yeah, wisemoneyblog.com will auto direct you right to the right spot. So,
Wise Money blog.
yep. It's almost like that was intentional. Wise Money Radio, Wise Money blog. Almost. Yeah. Sorry. My idea. Could be a terrible
Hurt
idea. I don't
yourself,
know.
patting yourself on
Yeah.
the back there.
All
He's
right.
very creative, by the way.
Mm.
I would have never thought of that, Mike. Hey, and we're saying 24, but I'm looking at lots of tax projections, and it's 26.6.
26.6. What are you talking about? 24.
The standard deduction.
Oh, yeah.
If you're over age 65,
Yeah, over 65.
you get a sweetener.
So you show them. Last year you had the exemption, and you had
Right.
15.2.
You're
That adds up to 23. 3, I think.
don't do math on the radio. I've learned, I learned that from experience.
So the question is, would you rather have 23.3 or 26.6?
Right. Yeah.
Huh? Would you rather have a $1,000 credit or a $10,000 credit?
Yep. That's good. All right. So starting segment 3, we're going to hit Ron's question about gifting to charity and all that.
Hope you're watching, Ron.
How do you make a gift to charity and make sure that even with the standard deduction now being higher and tax law changes different, that you're still getting as much tax benefit as possible? We're going to be talking about that here right now. This is Wise Money with Korhorn Financial Group. Thanks for being with us. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Thank you to Bethel College Adult and Graduate Studies, soon to be Bethel University Adult and Graduate Studies, as well as Diane Bennett with Remax 100 for partnering with us on the Wise Money Show. We've been talking about gifting strategies. The first half of the show has been, what if you're gifting to individuals? So if you've got family members or friends or someone that you're trying to bless and you're gifting money to them, gosh, there's lots of questions there. Is it taxable? Is it taxable to them? How should you structure it? So if you missed any of that, be sure to catch the first half of the show on the podcast or on the website. We're about to turn the discussion to gifting to nonprofits. If you have a question, find us online, wisemoneyradio.com. You can call or text 574-222-2000. And last, you can submit questions and follow the show on Facebook, Twitter, and YouTube. Just search Wise Money Radio. So Ron is 52. He's from New Carlisle. And here's what he asked. I prepare my own taxes every year. The past several years, I've itemized around $20,000 of total deductions. With the new standard deduction being $24,000 for a married couple, it looks like I won't itemize this year. Is there anything I can do to still get a tax benefit for the gifts that I make to my church? It's a great question, Ron. And I like how you phrase that as the gifts I'm still doing. Because
That stood out to me as well.
gifting should be in your heart and in your character, not purely motivated by taxes. And I wrestled with this when I was first enlightened in learning about financial planning. Okay, well, wait a second. I can get some tax benefits for this. So should that wield what I do? And I don't think it should. But you are a steward. And so you should be mindful of how you can do your normal giving out of your heart and still get as much tax benefit as possible.
Yeah, I agree with that. And The thing to keep in mind here is you're exactly right. You have your numbers accurate, Ron. You're saying that you used to be able to build your own write-off, and it accumulated to about 20,000 each year. But now the government's offering you a freebie of 24,000. So how are you going to be able to build one that's better than that? And there are some folks out there that use a strategy of kind of bunching up some of their contributions for charitable giving, where they will give 2 years in one. Rather than wait until January 1 to gift money for next year, maybe they squeeze an extra gift into this year, right in the end of December. And so essentially you're getting 2 gifts done in the same calendar year, which might allow you to creep up over that 24,000 threshold that the government has now created.
And so the folks that are bunching, you're kind of looking like we're going to be able to itemize 1 year and then not itemize the next, and then itemize 1 year. So I'm seeing it every other or every third year, where when you're bunching dollars together, you're itemizing one and then off a couple.
Yeah, so just to keep the math in mind here, Ron, if you are used to having write-offs of 20,000 and you need to exceed 24,000 now before it benefits you in any way, the first $4,000 of that extra bunching of gifts is not going to do anything for you. It's only the dollars that go above and beyond that. And the issue that I have with this is, I'm familiar enough with, I don't know how large the church is that you attend, but there are some churches that if you were to change the pattern of your normal giving, it actually would have an impact on their budgeting and their planning and paying bills and things. So whatever you do, this is meant to be a blessing. For some of you would view this as an act of obedience. Whatever it is, it's a generous spirit that you're trying to bring, and you want to benefit the organization that's receiving it. So it's not out of the question to have a conversation even with some of the leaders within that organization and tell them what you're doing. There's another strategy actually that we've done this year with many clients who are over the age of 70 and a half, where it's similar. I've had some clients that they would tell me every week, we're dropping some dollars in the offering plate at church, or there's an organization that we're supporting on a monthly basis. And if they instead gift a lump sum of dollars straight out of their IRA, there is a strategy that would allow them to get an even better tax benefit because they don't even have to count that distribution from their IRA as income on their tax return.
70 and a half, that's the magic number there. Even if you turn 59 and a half and you can start taking money out of your IRA, they still don't let you do this. You got to be 70 and a half for that one.
Right, you have to be 70 and a half for that one. And the idea is I'm not trying, that is not going to help me with my deductions.
Right.
So as far as I've said, hey, I'm going to take the standard deduction. I'm not worrying about itemizing. Or you still could itemize depending on what your other gifts are. But you say, hey, this money, I'm not going to get a deduction on my taxes, but you do in the fact that you don't pay any taxes on it.
I'm going to go and possibly embarrass myself here because I haven't done this. I just had to research it for a client, and it's looking like the research is suggesting that you can. You can do a qualified charitable distribution, what we're talking about, the one where you take money right out of your IRA and send it to the charity on an inherited IRA.
I don't think so.
You don't think so? So I was just doing some research, and I found a couple articles suggesting that you can.
All right.
Well,
I'd love to read those.
Yeah.
The other issue here is you have to be 70 and a half before you do this gift as well. It's not the year that you turn 70 and a half. We were so close to making that mistake with a client earlier this year. Those of you that have heard the age 70 and a half, the reason it's significant is when you reach that age, the IRS requires that you start pulling money out of the IRA every single year or out of your retirement accounts. It's because they want to tax you on that money. So they do a calculation, or you have to do a calculation to pull money out every year, a minimal amount. And what this new rule allows you to do is instead of receiving that money and counting it as income on your tax return, you can now send it directly to the charity of your choice and then not even have to count it on the tax return. For many of you, that is better than trying to take a deduction on that old Schedule A, trying to itemize and build up your own deduction. The reason is by reducing your income sources, not counting that IRA distribution, you may actually be reducing the amount of your Social Security that gets counted on the tax return as well. So you can get a double benefit potentially by doing this type of a strategy. I've been showing a lot of folks on tax projections this time of year how the strategy we implemented earlier in the year is having such a major impact on their tax picture.
Yeah, and the contrast is I take $10,000 out of my IRA, put it in my checking account, and write a check to the church. That's and when I do that, that does influence how much of my Social Security would be taxable and all of the other things. And I will pay Indiana or Michigan tax on that money as well.
Good point. Yep.
And so if I send it to the church, I do not pay federal taxes or state taxes on that, and it does not impact my Social Security. So it's a big deal.
There's a couple other considerations here when you're trying to when you're giving to a nonprofit and you're wanting to make sure you're getting as much tax benefit as possible. One of the other things that we've talked about in the past is, well, are you giving cash? Most people are used to just giving on a monthly basis, and I've had some people argue as I share some creative strategies. They say, nope, I view it as sacrificial giving. It's got to come out of my monthly budget, and if that's you, that's fine. That is just fine. If you view it as, nope, these are just resources I have stewardship responsibilities for, whether income or assets, well, if you have appreciated investments in a non-IRA account, you could gift those assets, sorry, not dollars, you could gift those assets to that nonprofit, and you could give them that full amount or whatever the amount is, but then when they sell it, they don't have to pay tax on that growth, on that gain. Whereas if you were to sell it, and this is a little Jedi mind trick, because even if you say, well, I wasn't going to sell that this year. Yeah, but whenever you sell it, whenever you do, even if it's down the road and whatever, then you're going to have to pay the tax on it. So it's a way of avoiding some tax and getting some tax benefit for a gift by just simply saying, now I'm going to give this asset instead of this income. There's a couple other things. You might have heard of something called a donor advised fund. There's a few other issues that we need to talk about when you're giving dollars to a charity. Also, state tax benefits for gifts. We're going to hit that and hopefully a few more questions as well. That and more coming up here on Wise Money with Korhorn Financial Group.
Yeah, we definitely have to do the reminder, if you're a married couple, you need to be given $400 to Beth.
To who?
Easy for you to say.
Okay, so now I'm seeing that it says you've got to be 70.5. But what I'm seeing here is not connected to an inherited. Did you see it where it's specifically an inherited situation, or is it just that the rules, you've got to be 70.5?
I think it's that you have to be age 70.5, and so an inherited IRA, you could be 45 and required to take money out of that.
The person we're doing the research for is actually 70.5. So in his situation, that is a moot point, but I'm not seeing it here.
No, that's a tricky issue.
It is. Yeah. Yeah, it doesn't even. Age restriction.
Man, I hurt my back this morning working out. Are either of you a chiropractor on the side, moonlighting?
No. I think it is that 7.5. I think you're right. All right. 4 segment, land on the plane. And yeah, hopefully if we do have time to sneak in another question, I'll grab Tammy's question above Aaron's. But I mean, we should be able to get a question in. So, all right. Have you heard of something called a donor advised fund? Should you consider it? Is it the right strategy for you? Why would you even have it in the first place? All of that we're going to be talking about in just a second. Thanks for being with us. This is Wise Money with Korhorn Financial Group. My name's Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. If you've missed anything, you can catch up on every previous episode in several ways. First, online, wisemoneyradio.com. Every episode's right there. You can listen while you work or whatever. You just have it pulled up on your browser and listen right there. Every episode's also on the YouTube channel. We record the studio while we're in here, and you can watch the video right there on the YouTube channel. Subscribe to it. You can share it, like it, submit questions that way as well. Lastly, every episode's also podcast. And I've shared this a couple times, but as people are traveling and the holidays and whatever, if you've got a long drive, you want to binge some podcasts. We've had fans of the show say that they've done that and they've enjoyed it. So you can subscribe to the podcast wherever you listen to podcasts. But iTunes, Google Play, the normal ones, yep. Just search Wise Money with Korhorn Financial Group. That's Korhorn with a K. All right. We are in the middle of a question from Ron about gifting to a charity and nonprofit. And with the new tax law changes where essentially standard deductions have been doubled, I might not get a tax benefit for these charity donations that I'm making. Are there still some ways that I can get some tax benefit? We've been sharing a couple. I want to pick back up with something called a donor advised fund. Kevin, can you talk about what that is real quick before we talk about the application of it?
Yeah, to oversimplify, it's a fund where I write a check and I put the money in the donor advised fund. And once the money goes in, I get the deduction. So I get that deduction that year. And I have really I'm going to need some help.
You got a frog in your throat. That's what you have.
I mentioned earlier Kevin's got a beard going right now, so I don't know. Maybe you got a fur ball in there, Kevin.
I'll help you out, Kevin, while you clear your throat.
Thank you.
So a donor advised fund, it's almost like an investment account, a pool of money that you can build up to get a tax write-off in the year that you make the contribution, but then the dollars can be invested in growing for future gifts. Think of it, you could almost run this as if you've built your own little endowment.
That's right.
Right? You set up an account, whether it's with Fidelity or another company, you shift either cash or stocks, other assets into this account. And the nice thing is that this donor advised fund is essentially a charity. It gives you the tax write-off when you shift money into the pool, and now you get to invest the dollars, and as it kicks off income or as you want to raid the principal to send dollars to the charities of your choice, you can do that over time.
Think about this. This addresses two big problems, and I'm just got really excited about one because I was thinking of a client case that I'll share with you in just a second. But the other one, we talked about a problem earlier. If you're bunching gifting and you're trying to help an organization that is relying on donations, and all of a sudden you go silent on them for 12 months, that might really harm the bit. And you're not wanting to do that. Mm-hmm. You're not wanting to harm, you're wanting to help. You could set up a donor advised fund and you can structure it so that the money gets passed on to that organization that you're trying to support on an ongoing, frequent basis so it helps them with cash flow. The other thing, though, and this just got me excited, I had some new folks come in who sold a little retail shop that everyone loves in the area, and they popped in and said, hey, we want to talk about planning now that we've got these proceeds, and I'm also concerned about taxes and so on. And we were talking about some of these gifting strategies, but I didn't talk about for this year, and we only have a couple weeks left. Yeah. They could put a big chunk into a donor advised fund because they're going to have big income this year and big taxes.
Yeah, I had a client that just had a liquidity event, and they said, hey, we want to put 10% of the proceeds. We want to gift it, but we are not exactly sure where we want to gift it. We want to give to our church, but we don't think we want to give it all to the church. And I said, well, let's get the credit because this is happening right now. So let's get the credit. You're going
to... The deduction is what you're meaning, but the benefit, I think, is what you're you're saying there.
Yes.
Get the benefit in the year that you have the income.
Yes.
Take it now, and then the dollars will be spread out to the charities at the timing that you choose. I've seen some families where they'll use a donor advised fund to get kids involved as well.
Yeah.
You know, they either help contribute or they help decide as a family what are the organizations, what are the missions that we care about the most, and how do we want to support them together.
But this is the year. This is the year to match the benefit with the tax situation, because never again, as far as we can tell, will they have a tax year where they're going to be paying taxes on millions and millions and millions of dollars.
Mm-hmm.
So if that's your situation this year, this would be the year to crank a bunch of money into a donor-advised fund, and when the dust settles, you can decide how to distribute it.
Let's go back to just a couple basics here that need to be mentioned when we're talking about charitable giving and taxes. With all the hoopla going on about tax law changes and deductions and charitable contributions, if you're still going to itemize, you'll still get your full normal charitable deduction donate. You know, that it's going to work like normal. I'm a little concerned for some of the nonprofits out there because there's been so much discussion about this. It's gotten people into a frenzy. Listen, if you're already going to itemize because you've got enough mortgage interest and enough state and property taxes and all that other stuff is going on like normal, you're going to itemize anyway. It really doesn't apply to you. So you can just continue to donate like you normally have done and you'll get the normal tax benefit. So keep calm and donate on, I think is what I would say. But then the second thing to mention is we still have this incredible tax credit in Indiana for donating dollars to an Indiana college or university.
Huge deal.
And we had a great time with Dr. Chenoweth on the program a couple weeks ago, talking
from Bethel College.
From Bethel College, and we talked about this a little bit. Josh, I don't know if you want to share it again, how exactly that works, or Kevin.
Yeah, I think what you're referring to is that in Indiana, when Hoosiers, or at least those who are filing an Indiana tax return, if they gift money to a college or university here in the state of Indiana, you get a tax credit for 50% of the money that you donate, up to $200 per spouse. So each spouse or each married couple, let's say, that donates $400, they're going to get $200 of that right back on their tax return within the Indiana system. And that's a big deal because, you know, I'm actually familiar with the donation patterns of most schools. A healthy school has around 20% of their alumni, for example, that gift back to the school. 20%. And, you know, the other 4/5 of those alumni, of that alumni base, still get this credit if you live in Indiana.
Yep.
And you're given to an Indiana school. So I would hope that the Indiana colleges and universities have a much higher than 20% donation or support from their alumni because of this tax benefit.
Yeah, but here's the deal. I'm a Chippewa, right? So I went to Central Michigan University. Mm-hmm. I can still write a check for $400 to Bethel.
Yep.
Because I'm married. $400 is the cap that I get credited on, but I get a $200 credit on my state tax return, and if I'm itemizing, I get to that $400 works against my federal taxes as well.
That's right.
Let's just recap all of this. With the new tax laws, and we said this earlier, whether you're giving money to a family member, an individual, or to a charity, it's critical to have a planning approach.
Yes.
Kevin gave an example earlier about if you're, the end result as far as a gift is still the same, making a $25,000 direct contribution into a 529 in 1 year. The net result to the recipient is going to be the same. But with a planning approach, the net result to you could be thousands of dollars of difference. So I like with every show, we want you to take your next wise step in your financial life. And some of you, hopefully, got some new strategies or have some new ideas percolating. But hopefully most of you are thinking, I need to involve my certified financial planner who's doing comprehensive financial planning into my giving strategies to make sure I'm doing everything appropriate. So, all right, that is all the time we have for today. Thank you so much for being with us. On behalf of Josh Gregory, Kevin Korhorn, and myself, and all of us at KFG, have a great weekend. We'll see you next Saturday for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.